We're going to move from real estate to the airline sector. There are growing worries there about the balance sheet health of that industry. And you can see those investor concerns not only in airline stock prices, but also in the credit default swaps of AMR and UAL. Let's go now to our markets desk, and John Ehrlichman has all the details.
Well, you're absolutely right, Scarlett. If we look at the stock performance of those names, like AMR, like UAL, like U.S. Airways, investors certainly have been voicing their concerns this year. We spoke with Hunter Kay, who's an analyst over at Stifel Nicholas. He says liquidity is the #1 issue for this industry right now. As we move past Labor Day, it's widely expected traffic numbers go down. That means less cash coming in at the same time that these airlines don't want to trip covenants, agreements they have with lenders over things like maintaining certain amounts of cash on their books. They have these agreements with their partners too, like the credit card companies. If you're an American Express, you don't want to get into a position where you're not getting paid by the airlines. So if you trip those covenants, they hold on to some of that cash. So we are seeing some significant developments in the world of CDS. In the case of AMR, for example, this yellow line just kind of shows you where we are today and when we were last at this level. That was back in July 2008 when crude prices were north of $130. A rise steadily recently, and it's not a different story, by the way, Scarlett, if you look at what's been happening with UAL. Again, we're at our highest prices since July of 2008, and we've seen a 60% move since the middle of May. Now, we contacted both UAL and AMR for comment. UAL was not available. AMR said it doesn't comment specifically on its CDS. But the other factor out there is that earnings are right around the corner for these two particular companies. In the case of AMR, we'll be waiting for some results in the middle of next week. Back to you.
Thanks very much, John Ehrlichman.